Hello, hello. Dan with G2 Jake here. Welcome back to the True Success Podcast for episode 41, the new retirement tax saving strategy in 2026. If you're a high earner over age 50, the IRS just handed you a massive gift for 2026, but it comes with a hidden tax bill that's going to catch thousands of people off guard.
What's up, everyone? We're talking about the new super catch up rules. You can finally stash away more than ever before, but for the first time, the IRS is forcing your hand on how to pay the tax. To keep more of what you earn, you really need to be more intentional with how you save.
Exactly. Today, we're going to break down the $35,750 limit, the mandatory Roth move, and why your autopilot retirement strategy is officially obsolete. Let's let it rip.
All right, so let's look at the scoreboard for 2026. The standard 401k limit, which everybody gets, is now $24,500. If you are 50 years or older, you get the usual $8,000 catch up.
But here's the kicker: if you're between 60 and 63, you now have the super catch up. That's $11,250 on top of the base.
All right, let's do the math on all this. That's $35,750 into a single account. So for a couple that is both in that age bracket, you're looking at over $71,000 in a year. That is a massive wealth building engine.
It is a massive wealth building engine, but I think a lot of people are going to get caught off guard. This is the blinded by the light moment. If you made over $150,000 last year in wages, the IRS says you cannot take a tax deduction on that catch up anymore. Secure 2.0 rules now mandate those catch ups go into the Roth bucket.
Which leads to the obvious question that we're answering for many of our subscribers. If I don't get the tax break today, is it even worth it?
But wait a second, Jake. That's the wrong question. People are obsessed with the tax deduction today, but they're ignoring the tax time bomb in the future.
Exactly. We talk all the time about tax diversification. If 100% of your money is in pre tax accounts, you don't really own all that money. You're partnering with the IRS, and they get to decide their cut whenever they want.
By forcing you into a Roth catch up, the IRS is actually doing a lot of folks a favor by helping you build a tax free bucket. Think about your future self. No RMDs on that Roth money, no Medicare surcharges on that Roth money, just pure, clean liquidity.
If you're a high level executive or a business owner, you need to look at your tax buckets like a diversified stock portfolio. So you'll need some pre tax for the immediate deduction, some Roth for tax free legacy and income, a taxable brokerage account for capital gains treatment, and a lot more flexibility. And then don't forget about the HSA, which is your triple tax free secret weapon.
I love that secret weapon. Two families can earn the exact same income, but the one with a multi bucket strategy can end up keeping 30 to 40% more in retirement. We call it restylement than the one who stayed on autopilot.
And that's why this isn't a 401k conversation. 21.6 is the year to stop thinking about contributions and start thinking about tax design.
Yeah, I like that tax design. And that's the point. More income creates more opportunity, but it also creates more chances to overpay in taxes if your strategy isn't intentional.
And in our opinion, this brings us back to what we think true success is all about, not just making money, but keeping more of it and then using it with purpose how you want to.
Exactly. Be the smartest guy, be the smartest gal in the room who's proactive with their money. If you want a living, breathing plan that actually accounts for these 2026 shifts, head over to our website.
All right, so let's build something that lasts because at WMGNA, we figure it out so you don't have to.